In this video, we're going to look at City Office REIT. And what I do in my videos is I run a discounted cash flow model to figure out the real value of a stock. And we also look at the financial ratios of the company and compare them to others in the same industry. So let's get started with the model. So this company has a market cap of $473.5 million. And that's the value of the company according to the stock market. And the stock is trading at $10.01. So if you wanted to buy a share, that's how much it would cost. Now we're going to pull their free cash flows. And free cash flows is cash flows from operations minus capital expenditures. And if you want to value a business or an asset, you have to estimate the future free cash flows and then discount that number back to today's value. And that's exactly what a DCF model does. Now I'm going to pull the net income, which is the profit and loss according to the income statement. And the income statement uses accrual accounting, not cash accounting. So sometimes the values could look a little funny. We also need the revenue, which is the sales for the business. And for a REIT, that's a lease and rent payments to its customers. In 2016, they had a $1 million loss, yet positive $19 million of free cash flow. So they must have took a lot of depreciation that year or possibly passed through a loss from prior years. The net income is a little volatile, but the free cash flow and revenue seem fairly steady. Let's look at the capital structure of the company to figure out what discount rate to apply to the future cash flows. So they pay $28 million of interest on their debt, and that's on the income statement. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section and current liabilities. They have no current debt, non-current liabilities. So they have long-term debt of $607 million. That means that's debt due after 1 year. So it might be due in 2 years, 5 years, 10 years. And the cost of debt is 4.7%. Let's figure out the cost of equity. We need the company's beta for that. The beta is the volatility of the stock. And this stock has a beta of 1.27, so that means the stock moves about 1.25% of what the market moves. So if the market went up 1%, this stock should go up roughly 1.27%. We also need their current assets to get some of the ratios for later. So we'll go back to the balance sheet. We'll go to assets, current assets. This mainly consists of cash, accounts receivables, and inventory. That's $124 million. And let's get their current liabilities. That's $29 million. These are liabilities that are due within 12 months. And let's get their equity. That's the total assets minus total liabilities. That's $548 million. And their EBIT is their earnings before interest and taxes, or operating income. That's what they call it on the income statement. And that's $29 million. To figure out the weighted average cost of capital, it's a blend of the cost of debt, 4.68%, and the cost of equity, 12.07%. And they have 53% of debt in their capital structure and 47% of equity. And the cost of equity is figured out by using the capital asset pricing model. And the weighted average cost of capital comes out to 8.19%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, and that estimation is based off of the financials we input earlier. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today's dollar amounts, and we get a value of the company of $375 million. We divide that number by 47 million shares, and we get an intrinsic stock price of $7.93. They're trading at $10. They're trading at a 26% premium, so it's a sell according to the model. Let's see what Simply Wall Street values the company. Their intrinsic value is $12.73. So if they're valuing the company at a buy, they're saying the value of the stock is worth more than they're trading at, and I'm saying less. Everybody has their own models and their own assumptions. Let's see where the stock has traded the past few years. It looks like the stock price was over $12 at several points the past 5 years, but then it dropped a lot at coronavirus to around $7, and it's come back up to 10. So stock price is really based on supply and demand in the market and how people predict the future of a company. Let's look at the financial ratios to get more information. The PE is really high, 263. That's a bad PE. That's price to stock over earnings per share. So they must have really low earnings to have such a high PE. Price to sales is not too bad, 3.0. That's price to stock over sales per share. They have a good price to book value of 0.9. That's price to stock over book value per share. That means investors are willing to pay 90 cents for $1 of book value. Their current ratio is a little high, 4.3. They don't need that much current assets. 0% ROE because their net income is so low relative to their equity number. Interest coverage ratio of 1, so their operational business could just cover their interest payment on their debt. There's nothing left over to pay dividends, so they may have to go into more debt in order to pay dividends. 53% debt, which isn't too bad. Now the best way to look at ratios is to compare them to others in the industry. So I did 2 other office REITs on this channel, SL Green Realty and Vornado. And this is CIO right here. And if CIO's number is in red, that means their ratio is worse than the average of the 3. If they're in green, then their ratio is better than the average. And if something is in orange, that means they had the best ratio for that category. So VNO has the best PE ratio, 2.4. SLG is not bad at all, that 14.2, but of course CIO is way over the top. Price of sales, CIO is the best, but it's a fairly tight range with the 3 companies. All the companies have a good price to book ratio. All the companies have a fine current ratio. ROE, CIO and SLG are doing terrible. VNO is doing great in ROE, so they're providing a good value to their equity holders. Debt, they're all in the same range of debt, around 50%, so that's pretty good. And CIO is the smallest company of the 3. So let me know what you think of the video. Do you invest in REITs? Thanks for watching.